Good morning, everybody. Welcome back to the Schwab YouTube coaching channel. It's our Thursday edition of Trader Talk in today's market, and I am your host, Kevin Horner. Thanks for joining me today, everybody. We've got a little bit of a green start this morning. We're going to look at some headline news and, of course, a bunch of charts. We have some stocks in the news this morning as well, and some opportunities to position for new example trades in our example portfolio. So I'm looking forward to getting into all of that with all of you. So thank you for being here this morning, everybody. Today, I'm pleased to be joined by Barb Armstrong in the chat. She'll keep an eye on things for me there. She's a fantastic coach, of course, formerly a student of the education offering here, and now a coach, fantastic at that. So make sure you're engaging with Barb there in the chat, of course. Like I said, I'll keep an eye on things there. Definitely want to hear from you as you're posting in here. So if you've got specific questions, let me know, and I'd love to address those. See some very familiar names here in the chat this morning, names with whom I'm familiar because many of you are here very frequently. A few of you had been able to make it out to the Denver event. It was great to meet some of you there. Always great to have some familiarity in the chat. So also, remember, you can follow Barb and me on X, Barb Armstrong CS and Kevin Horner CS. Try to post for you there throughout the week, give you some things to be aware of, maybe some charts, perhaps some positive viewpoints on things, in the sense that, mental makeup is a very big part of being a good trader, and controlling our emotions. Another big aspect of it. One of the things that Barb speaks to quite a bit is that viewpoint on positivity, right? Everything works out for us if that's our approach, if that's our viewpoint at least. So with that, let's get to some disclosure details, everybody, and then we can move into the good stuff for you all. Remember, our conversations here on the channel, they are exclusively for your information and your education, meaning simply we do not make recommendations here. Expressions of opinion are always subject to change without notice. And further, we utilize technical analysis quite a bit here. So we cover concepts and strategies that traders will employ when thinking about trading. And those strategies and concepts are generic in nature, but you shouldn't base decisions exclusively off technical analysis, nor should we base decisions off any one thing exclusively. I think it makes sense to consider the market as a gigantic puzzle and one that requires many pieces, and therefore we want to incorporate as many pieces to see the true picture of things. That is a process that we try to cover here in the Trader Talk conversation. So let's look at an agenda here. If you are new to the segment, this is the process that we go through. We start with looking at the major indices. So we'll start with the S&P 500. We'll look at the NASDAQ 100 as well. Also the Russell 2000, a couple of other groups beyond that, industry groups like semiconductors and maybe software, things like that. But not to mention sectors, and then down into individual equities. And the reason we do that, for those of you who are not frequent attendees, is to really give us the snapshot of where money revolves in the market, or is moving around in the marketplace. And if you think about it from that top-down methodology, it helps us to kind of work our way through the most important aspects, the broader aspects, and drilling in to find the areas where opportunity may lie for us. So try to speak to that as much as we can here today. And your questions might drive the conversation a little bit. So again, feel free to post in here for the duration of our segment. Now, since we are, I know we always have new attendees in these segments, I want to remind you that we do have an external event opportunity for you here. We are out and about on I guess, a once or twice a month basis, twice a month usually. We're looking at being out a total of about 23 or 24 sessions this year for live events. The most nearest upcoming one is the one in Anaheim here at the end of the month. So you've got Miami and New York on deck thereafter. Those are market drive events. Let me give you just a brief understanding here, everybody. The Anaheim is a workshop that'll talk about advanced options, AOS, advanced option strategies. So if that's something you're looking for, that is a wonderful opportunity to check that out. Now, the market drive events are single day events, and they are more in line with the overall macro viewpoint of where we reside in the market. What are the things that investors and traders are discussing? What are those things, what are the important pieces of information, market data, economic health, etc., that we as investors and traders need to be aware of. So the market drive is slightly different from the traditional workshops, which are really just an extension of what we do here on the YouTube coaching channel. So you can check all this out at schwab.com/events, the same place where we house our calendar for the day-to-day live events and live conversations we host here like this one on the channel. So check that out if you're interested in getting out to the live events, everybody. We'd certainly love to have you there. All right, so we're going to start us off. Like I said, pretty good bit of green on the screen this morning. We've got the S&P 500 up here, everyone. And we have seen that we've now managed to maintain ownership or holding of that 50-day moving average, that being the nice purple line here. As you can see, it is down sloping, starting to flatten out a little bit as price action has maintained a ledge over about 55.50 or so. This was an important level for us to recapture, everybody, just to get through this zone. You'll notice, like I said, that the 20-day moving average has already given us that nice fish hook move where we are, kind of dabbling with the opportunity to get up and cross the 50-day moving average to the upside. This can be a potential shorter-term indication of that health and strength. It's really just a reflection of the prices really rebounding quite nicely. You'll notice if I drew a line here, everybody, from our lows at 48.35 or so to where we reside today at 56.67, we are currently up about 17% off the lows. So just as a heads up to that extent, everyone, a really great rally and a wonderful reminder that selling into weakness can be very difficult to do. If you were a seller back at the first week of April and did not put yourself in position to participate in this rally back, you probably haven't been enjoying much of this rally back. And the risk, of course, in not preparing oneself for potential rallies, and I do say potential because there was no guarantee that we were going to get a rally, but what we did get was a little bit of over bearishness. And sometimes sentiment can be a leading indicator for us. And so if we have too much bearishness, if bearishness is pervasive in the marketplace, believe it or not, it can lead to a brief pop. Now, I'm calling it brief because it's been brief to this point. It's unclear whether we've got something bigger working under the hood. If we want to take a more standard technical analysis 101 viewpoint, let's just drill into what has happened since we peaked. So we've had a broken downtrend that has been not just broken, but some traders would tell you that we tested it properly on this day too. So we have this downtrend in place. We've failed at it a couple of times, right? Once here, here we go. Once here potentially, right? And then we got above it, and now we've managed to hold. So the 20-day moving average was some resistance, and then we were above it for 1, 2, 3 days. And then we just kind of tested the downtrend line, not the 20 yet. But if you were waiting or working with this and looking for your opportunities, aggressive traders might have started on day one, maybe not, because, I mean, again, aggressive would be the term there. Day two, maybe day two of holding an important resistance level, former resistance becoming potential support. And then day three might have been the day to go ahead and get started if you were looking for some additional confirmation, as Wiley's pointing out, the so-called Horner rule. Essentially, what we're looking at is just confirmation, everybody. Some of you would be comfortable on that first day. Some of you would have been comfortable day two. Some of you were looking for day three or even longer. Ultimately, all I ask of you is to define your confirmation. What is it that gives you the comfort to enter a trade that has, at some level of indication that the short-term trend is maybe shifting, okay? So since then, we have been above the 50-day, so we've got 6 days above the 50-day. We're getting a little comfortable with it as our potential new support. So let's monitor that for very short-term levels in the neighborhood of about 55.75 down to a 55.50 or so. You'll notice the level here, 55.55. Boy, lots of nickels there, everybody, at the 50-day moving average. Always fun when numbers come out in the wash like that. So we're waiting for, essentially, however, still new highs in the SPX. If I clear my draw tool here so that everything gets a little cleaner, check this out. I mean, we have not yet gotten through this ledge here. So we have failed at this level before. This is an important one in the short run, as is the 200-day, which is right above. So that white line might be a little too fine for some of us, and maybe it's more like a zone in here. Meaning, as a reminder, intraday moves can absolutely take you through levels you didn't think we were going to get to. And the question then after becomes, can we hold those levels on a closing basis? I don't think short-term bullish traders would be surprised to move into my rectangle here, but they would also perhaps consider taking profit on short-term positions that have been established in the recent few weeks here as we've rallied back. This becomes an excellent point for profit taking for those bullish traders. And reminder again, the decision to take profits is obviously each of us as traders, that's our own. But the question becomes whether you're a profit taker on full position size. Are you 100% in trades and out of trades? Do you just go black and white across the board? Or do you massage your position sizes based on your comfort? Do you buy a little bit here and a little bit there with confirmation? And do you sell a little bit as opposed to selling the entirety of a position? Many traders like the idea of piecing out of their positions as you approach areas of resistance, simply because it gives them greater comfort with the remaining shares. And as a reminder, there's nothing to suggest that you can't re-add shares you've taken off when you then have greater comfort. So someone who took trades off here in my rectangle, my zone of resistance, if we got closes back over 5,800, which would then be new short-term highs, well, I think you would see some of those dollars coming back into the S&P 500 even still. So the rally back has been great. Not higher highs just yet in the intermediate term. So we are still looking for a little bit more from the S&P 500. And the truth of the matter is, we're going to be looking for the same thing in the NDX, everybody. The NDX has made a very similar move. The only difference is that we have already tested the 200-day moving average. I do have my Fibonacci tool drawn in from yesterday's conversation with our friend Brent Morris, and we talked a little bit about that 61.8% level being a very important one for bounce backs here in the NASDAQ 100. If you're a user, or maybe let's say you're unfamiliar with the Fibonacci moves, sometimes these levels can carry a lot of water for the short-term traders. They can give you areas around which to set exit strategies, limit orders to the upside, stop orders to the downside, those types of things. So when you look at 61.8 for a trader who says, I want to see that the trend to the downside is officially broken, and we are going to be right back in gear above the downtrend line back into the channel or the trend that we were in before. Well, the 61.8% bounce that we've seen, meaning from the entire move, so with a peak at 22,222 down to our lows here, that move has bounced back 61.8% of that sell-off, okay? So the 61.8%, while 50% represents a level that a lot of traders will look to, the so-called golden ratio, if you will, the 61.8% is kind of a last-ditch effort. And I say last ditch, it's last ditch for the bears here, meaning if bears can't mount a stand at the 200-day moving average, ballparked at 20,000 or so, and that's that blue line I've got here, everybody. If they cannot keep the bulls at bay here, we're going to pop through the 200-day moving average on a close, and then we're going to see bearish traders getting uncomfortable and working to cover bearish trades. And that bearish coverage can then lead to bullish price action over the 200-day moving average. So this is a key level, everybody, that 20,000 zone here to up to about 20,200. The 200-day here is, let me just give you a level on it. I'm just going to look at the top. 20,180 at the moment is that. That golden ratio for you there is the 50% retracement I'd never eat here. That's what you're looking at. Very commonly, traders expect bounces following a retreat to be about 50% or so, unless we're seeing extensive selling or speedy selling. And conversely, when you rally up to certain levels, or if your rally is extended, then traders may expect a pullback of about half on the way. So common process that some traders will incorporate is to draw these lines once you've been able to determine is a short-term bottom potentially in. Again, I've said it before, we don't know if the lows we hit with the S&P, with the NDX here, the first week of April, we don't know if those lows are, quote, the lows, or if they are just a low in the short-term trend. So it's unclear even still, okay? So there's your look at the NDX and the SPX. Let's peek in on our small caps, also having a decent day here today. We've been below the 50-day. This is a pretty interesting development on the Russell because we have seen that we were below the 50-day for 2 days in a row after being above it for 2 days in a row. And when I think of how that works, remember, of course, we were just talking about that Horner rule, right? So when you think about the Horner rule and you get 2 days above the 50-day and then you're back below it, now you're below it for 2 days and then you're back above it, you've not had a confirmatory signal one way or the other if you were using the so-called rule of three here, right? So we are still learning something about our price action in the small caps, and it's telling us a couple of things. The first it's telling us, I think, is that there is a lot of action at this range. 2,000 is a very important level. If I extended my line to the left here and paired us back with a weekly look at things, you're going to see what I'm talking about. That line is a little bit wonky. So let's just redraw it at the 2,000 level. Here you go. I mean, we've been here before, everybody. We have talked about this live and in the moment, in fact, when this was going on. So yeah, we were looking at that peak, at this one here, and then the one right here. And as we often discuss in this class, old resistance can become new support. And once we cleared it, that's exactly what happened. As you can see, we held it here a couple of times, tested it, moved higher, made new highs, came back. And then when the selling got going in earnest here in late March or mid to late March, it became a spot for a brief, albeit brief pause. And then we fell through it. Well, now we're back to it. What once was support can now become resistance. And that's what we're waiting to see. Does that resistance maintain? If you're looking from the trend aspect, everybody, bulls really, really, really want to be back above that 100-week moving average here. We're pretty good. We're about 40 points away from it right now. So we'd like to get that accomplished from a trend standpoint, but it all kind of remains to be seen. As you can see here, everybody, the selling in the Russell has been pretty darn aggressive. Peak to trough. Whoops, let me draw that as a line. 2466 or so. Selling was pretty big. I mean, we're looking at almost a 30% drawdown in the small caps. So heads up there. The bounce has been good. Let's just do a Fibonacci move on that just for you all, since we were talking Fibonacci's earlier. And let's just see. Chances are, based on my just general sight, this probably falls in the 38% retracement zone right now. And if it does, oh boy, that was pretty lucky. Maybe that's just an experience situation. I hadn't drawn that one out, everybody. But to see that the 38% retracement comes in around 2012, that is pretty intriguing. Now, why do I say that? Well, reminder, if your retracements are shorter in nature, meaning you only bounce to the 23% or the 38%, well, then it implies that the selling is greater or stronger than you may have thought. So this could be a spot for a reversal in the Russell. It also could mean that if we can clear it, well, then we can squeeze our way up to the 50% retracement zone at around 2100. Okay, so that gives us something to look for. But again, you know, when we talk these levels, everybody, we're not talking about these from certainty levels. We're talking about these from if-then scenarios. What is the if-then statement as it relates to the Russell right now? Well, maybe if we make a new short-term high over the high we made on the 2nd, with a close over 2025, then some traders would tell you we could move our way up to 2100 thereafter. Doesn't mean that 2100 is just the next level and we're going to keep going, but the trader who believes in the viewpoint would get more optimistic and more bullish with closes over 2012 and would maybe be targeting 2100 just as an approximation. Okay. All of that is to say, I don't know if that's what's going to happen here. We're just as likely to get rejected at this level as we are to carry. But if we close above it, bulls are going to be a little bit more enthused here for sure. Okay. Let's take a look at the semis. Yesterday afternoon, we got a late report out of the administration here, the Donald Trump administration, that is, that they are looking at lifting some of the Biden era AI rules that are kind of hampering some of the semiconductors. And with that in mind, the market pushed a little bit higher. The semis in particular did. NVIDIA got a little bit of a lift as well, closing at one of the higher levels that NVIDIA had seen in recent months. So that was optimistic and positive as well. Of course, we had yesterday's FOMC decision, really, pardon the expression here, a nothing burger as it relates to the interest rates, of course. There were no changes to that extent. The conversation continued to be much like we expected. The quote, the committee is attentive to risks to both sides of its dual mandate and judges that the risks of higher unemployment and higher inflation have risen, end quote, according to the post-meeting statement. So the Fed is clearly keeping an eye on things, but also the Fed is a bit apparently loath to make an adjustment at this time. So we'll see how that plays out. I got to say, the one thing we've noted as it relates to the CME Fed tool is that the traders continue to position for rate cuts this year, but fewer rate cuts, it would seem. So every opportunity we get to hear from the Fed is one that gives us more detail, of course, and yet it sounds as though the Fed is going to be working much more data dependent here, right? They're not going to simply act on President Trump's desires pretty clearly, and we're going to continue to wait on some data. So keep our ear to the rail on that. You know that we're going to continue to talk about that here in this class. So absolutely something to keep in mind. Okay, let's see. Oh, there was one other quote that I wanted to give you, or one other note rather, from Fed Chair Powell. Said that in his post-decision press conference that if the large increases in tariffs that have been announced, if they remain at the current levels, they could lead to a slowdown in economic growth and an uptick in long-term inflation, as well as an increase in unemployment. So all of that is to say there are risks in this market, and perhaps those risks are tied to the willingness of the administration to hold the level that they have given themselves. So we'll see how that goes. But a lot of the conversation this morning has been tied to some of the optimism around a trade deal. There was a headline of expectation on a trade deal with Europe today. We'll see if, I think that that was supposed to be announced early this morning, and the markets have kind of given us that green lift on the initial open of the day. So we'll see if that all carries. The move in the SOX here, like I said, the SOX index looks very much like that of the NDX. The only difference now is that we opened above the highest high we've seen. So let's see if we can carry that. This would be a really great level to work our way through, and a lot of traders thereafter would start targeting perhaps that 200-day moving average zone above here if we could start to clear. I mean, this looks like a pretty deep V at this point, right? From the selling here in late March. So you've definitely got an uptrend working. The question is whether it can continue to work in the way that it has been. That 20-day moving average might be too slow, everyone, when you look at it, to be quite honest. That is, if you're using that for support, we're about 300 points away from it. Not ideal, right? The 20-day. So maybe some traders are using the 10. Let me just throw the 10-day in here just real quick. I'm going to go with only the 10-day. So this will kick out the 20, the 50, the 200. And notice that the 10-day, see how that works? See how the 10-day is just really, we bounced right off of it on Tuesday morning. The low yesterday hit it as well. So this is kind of an implication that there's a little bit of short-term enthusiasm here in the semis. So let's see if that goes further. By the way, if you've been using that 10-day and you like what you've seen, you bought it on the day that we got above the 10-day there on April 23rd, that is, and you'd say, hey, I'm happy. We've moved wonderfully. I'm up 300, 400 points, maybe 10% on the trade. A close under the 10-day would become a spot where the trader who bought because of the 10-day to the upside would start to cover some of that, right? So always be cognizant of the opportunity to take profit and the manner in which you as a trader want to take profit. Do you like to be a trader who sells into strength? Meaning, is today a day where you would take some of your trade off because of the pop? Or are you the trader who's comfortable giving up some of those profits and only likes to sell when things reverse course? In which case, that first close under the 10-day might be a first short-term signal. And you're right, John. For some of you, 10-day is very short, and it might not be valid. There's a lot of noise in a 10-day moving average, but it's also commonly viewed as a more momentum-based moving average as opposed to the 20 or 50-day, which is going to be more intermediate in term, right? So keep something like that in mind. Okay, so there's your semis. Now, I think it maybe look good to check out what's happening in the transports. The transports have been struggling, everybody. And, you know, the reminder that I'd like to offer you as it relates to the transports is what this group does for us. I mean, remember, this is how we move things across the country. And further, if it's how we move things across the country, one would say that might suggest that if we are moving fewer containers, fewer products, that speaks to the potential for the overall slowdown, right? Economically and both domestically as well as globally. Now, the trend here hasn't been good for a while. And it got going in earnest in early April with the announcement of the tariffs. And yet it was already in a downtrend. It had already broken the uptrend. So sometimes you can pay attention to the price action and just simply allow the price action to dictate for you. When we broke the uptrend line, and if I added a little time to this, you'll see what I'm talking about, everybody. Make this, in fact, let's go make it a 3-year. So there's your 3-year. Here's our low back to September of 22. Trend was working great. Bounces off the trend line led to new highs. Fantastic, until they didn't. And then we broke it, followed the 20-day moving average down. Now we're above the 20-day, so some of you are still feeling kind of comfy there, and it works. But movement back below the 20 and things get a little bit less comfy, right? Still, this has the visual makeup, the visual of a potential bear flag in here, right? And if that is the case, well, then maybe the bearish traders are a bit more properly positioned and may expect a break of the 20-day moving average to take you to the downside for a potential revisit of those lows. The caution, of course, is that we don't know which direction that's going to bust or break. It's in the flag, the cloth of the flag right now. But if you're a trend trader, the proper way to look at this is to take the trade in the direction of the break. The 50, if we closed above the 50-day moving average, or which would be above the trend line, some would then say, oh, time to go long, right? Bullish traders would want to go long at that spot. By the same token, a close below the 20-day in the uptrend line would be a spot where anyone who's been buyers of the last month would be looking to take some off, right? Or perhaps position for a bigger move to the downside here. That's also a possibility. Now, the last thing as it relates to this potential bear flag, if you remember, we just talked about those Fibonacci, so I'm going to bring them back. So let's just say that we have a legitimate breakdown, okay? How far back can we rally and still be considered in a downtrend? How can we look at that, right? So let's take that Fibonacci and let's say that we probably want to see that the rally has not taken us more than 61.8%. So let's just go from when we announced the tariffs, right? The close on the day we announced, and then down to here. And I mean, are we gonna? Again, you can call it voodoo if you want, everybody, but we stopped at the 61.8% retracement. Okay, so we rallied back the near 2/3 amount, and for many traders, I should say, only if we can get above 61.8% with any closes will they start to look for more bullish opportunities. And some of the traders out there would still say, yeah, that's all well and good, Kev, but I'm not doing anything until I'm above the 50-day, simply because we're in close enough proximity, right? What would be the real upside from here? You know, if you wanted to challenge the 50-day, it's only about 200 points. 200 points on a 14,000 point level, not a substantial position, right? About 1.5% to the upside, not necessarily big enough for a trade there. Let's see, more questions. Yeah, healthcare has been struggling. You're right. In fact, let's take a minute. Let's move through some of the sectors here for a little bit of sector action. We've got energy with a bit of a bounce. Notable because we had that same visual bear flag broken, and now energy is trying to get back. It wants to get back to the high in here. I say that because we can see today's candles letting us know, hey, we're good. Look, we set up new support in here, right? Nothing to see here. Everything's fine. Other traders will tell you, yeah, we still broke the bear flag. So maybe the tendency is to feel optimistic. But the fact is, we broke the uptrend line, and now we're trying to figure it all out again. Whole different viewpoint of things, right? So nice pop today, likely tied to the move in oil, which is up a bit today. Short-term lows at about $55 a barrel have been maintained. We had a test there on Monday, bounced off of it. We've been kind of rangy here, but notice the 20-day absolutely been resistance on the barrel. So heads up to that extent. Yeah, we could squeeze through it and maybe challenge the 50 like we did back here, but certainly no guarantees to that extent, of course. And only then a move through 60 are we going to start feeling a little bit short-term optimistic on oil. But it's having an impact in energy as we speak. We are getting a good move out of the communication space today, up 1%, which I find a little bit odd. I wanted to look at Alphabet. Google, formerly Google, Alphabet. There was a report yesterday out of Apple about how Google search was dramatically reduced in terms of the numbers, the figures associated with Google search. First time coming in lower than on a year-over-year basis, I think. And if you take a look at what Alphabet did yesterday, it also broke an uptrend line that had been in place. And get that drawn in there. So some traders would be looking at that and saying, yeah, I'm not feeling so comfortable again, right? Because that also has the makeup of a bit of a flag after a really healthy retreat off of the highs. 207 all the way down to this low at 140. Really, really rough for the long holder there, off about 32%. So a broken uptrend line. Maybe the uptrend line becomes resistance now. Maybe the 20-day does. We'll see how that happens. Does that become a new short-term downtrend on Alphabet? That's a possibility. In fact, let's continue to work our way through some of these new or equities, individuals in the news this morning, everybody. AMD had a nice announcement, evidently. They are up this morning as a result. We talked about this I think it was just yesterday, maybe the day prior, but being through the 50-day moving average and kind of looking for some validating closes over the 50-day has been helpful. Now, today's action, moving away from the action of the last week where we were kind of pausing. Notice all the back and forth in here, everybody. Yesterday's candle's a really good reflection of that back and forth ahead of the earnings. But AMD was upgraded by DZ Bank to buy from hold, a target there at 118. Again, we remind ourselves targets are never guarantees to be achieved, of course, but always want to bring that to you when you see a target adjustment or a new price target added. So, 118 is certainly good in terms of a level. Notice where the downtrend line I've drawn in kind of resides. If we looked at it today, It's right around 125. Where does 118 come into play on the chart? Well, somewhere in this vicinity here. In fact, I could probably just push that up to 118. Why not? I don't know if you knew this, everybody, but you can always put your levels in this way. So if you know the price you want and you don't want to draw the line, you can always adjust it after the fact or make your adjustment this way. So this is the target from the DZ Bank, at least as it relates to AMD. We'll see how that goes. We also heard overnight from AppLovin, APP. Now, APP had been on a bit of a downward trajectory for a while, and today has managed to kind of clear some important levels. We'll see if that maintains. We have put ourselves in an interesting spot here, though, everybody, haven't we? I mean, this is a stock that was a darling not that long ago. I mean, we had a tremendous move to the upside from the 390 up to the 5.25 level. That was fantastic. Added somewhere in the neighborhood of 25% pretty quickly. And then it completely reversed course. We've heard from a couple of short hedge funds, if you will, individuals that are, believing in their own story to a certain extent, right? And what I mean is they're positioned bearishly. They're letting you know they think there is other things under the surface, things going on that you need to be aware of. I think it was Muddy Waters who put out a report on App, kind of downplaying the ad revenue that they have earned. But I'll tell you what, when you look at a chart that kind of brings you back out of an aggressive retreat, this is a pretty fantastic bounce back at this point, everybody. So, App above the 20-day, above the 50-day with a wonderful open today. Could it be a resistance spot? Sure, but it has this incredible gap level to work with. And some traders would perhaps look at it as a gap and go scenario, whereby they might start a new position in the belief that the gap ledge will be maintained from here. It is a possibility, as well as I do. I don't know what's coming next, but the range we have traded in now is about 340 on the upside. Let's call it 345. And really our downside 225. That's about 120 points. And some of the numbers I've seen out of this morning for adjustments in potential price targets are putting this upwards of 450. But again, that doesn't mean anything, right? So as always, know the level that you want to trade with, know the levels that make sense to you, and then position that way, right? A lot of if-then statements, right? If the stock can do this, then I'm going to believe this, and therefore I will place this type of trade as a result. So wanted to bring that to you. Jefferies raised the price target on AppLovin up to even higher. Had been 460. They target now 530. That's new all-time highs, by the way. They maintain a buy rating. Despite highly impressive 71% year-over-year ad revenue growth, the firm, Jefferies, believes that the fastest growth still lies ahead, according to Jefferies. The other one was Goldman Sachs raising the target on AppLovin to 435, up from 335. They maintain a neutral rating on the shares. So with that in mind, I thought, let's go ahead and take a new trade in this position so that we can, discuss some of the process of building the proper trade. And if we looked at the lows of today and we assess that, and again, this is merely an example, not a recommendation, but if we were to assess that the report was favorable, sufficient that we could look at today's lows as a proper exit, meaning if we traded under the gap that we made this morning, that a trader would say, yeah, I'm no longer comfy. So perhaps there's our opportunity. And of course, with a nice tight stop like that, which would mean under 340 or so, that's about a 15-point level of risk. If we're just looking for a 1-to-3 ratio, we need upside of about 45 points, which would give us 400. Okay. So again, what I'm talking about is risk versus reward. Risk of 15 to profit 45 is a 1-to-3 risk to reward ratio. For a lot of traders, that falls into their comfort zone. Okay. So if we wanted to build a trade like that, what are some of the considerations that we should also include here? And I think many of you are going to think about this as well. Well, if we like the low today, what kind of risk do we have for intraday moves that could take us out of the trade, but maybe not, I don't want to get taken out needlessly. So I need to give it a little bit of wiggle room. Well, one way we can do that is with our average true range. So we're going to add ATR here. It is. So we'll add ATR. I'm just going to make that line a little more visible down below. All right, so ATR is $26. That's quite a bit. So here, under 340, if we really wanted to use average true range, well, then we're going to need to go under 340 by the amount of the average true range. That tells us more likely that we're looking at about 315 on our downside stop exit, right? Which wouldn't be that shocking, all things considered, but our hope would be that we don't incorporate that. Now, I think for this particular trade, while we could absolutely incorporate it, we'd basically have to be believers that we're going back to the highs, to make sure that we are targeting proper upside for the amount of risk that we're willing to take. I suggest that maybe we look to make this a little more tight in our exits. We'll use the low, but let's, instead of using the ATR, because this has been volatile, let's go below the low about 10 points here. And so we'll do an exit at around 30 or so, 330. It is, Ranjit, the answer to your question about ATR, it is average true range. And the reason it's average true range is that it is incorporating the gap move. That's why the number is high today. So today it's at 26, but if we went back to yesterday, the ATR would have been, more like 23 or 22 or something like that, right? Yeah, 23 and a half, 24. Okay, and that's because it's incorporating today's gap. And it's also calculating only the last 14 trading sessions. Okay, so hopefully that helps out. Now, in building the trade, like I said, exit will be about 330. And then let's just say if we're targeting 330, let's look for 425 to the upside. So we're just going to put an entrance with a bracket around it, everybody. So right click in the chart, buy custom with OCO bracket. One cancels other bracket. That simply means that we can only execute one side of the sell. Okay. Now I'm going to change this so that all my share totals line up. If I buy 25 shares here monetarily, 25 at 390 or so, it's going to be about $10,000 ballpark. All right, so a little less than that. That's a perfectly appropriate size of the position to this extent. So we'll do 25 shares, not 251, but long 25, which we will buy at market. And then our exit strategies, I'm dropping to good till canceled. We have an exit at 330 with a stop. Reminder, 330 is simply a trigger price. And once triggered, we will get a market order to sell. That means that if we close above 330, but the next day we opened extremely below it, like 300, that 300 open is going to trigger our trade, and we're going to be a seller at market, which is going to be a lot closer to 300 and not likely close to 330. Okay, there's risk with the stop order. Now our limit is going to be to the upside, and we're going to target 425 up there. And here the limit is always considered or better. Okay. And in fact, I see we're looking at 352 entrance. So risk is about 22, upside about 75. That's going to work out just fine from a risk reward standpoint. So let's go ahead and place it. And then you're going to see my exits on the screen here in my chart, because it's going to give me, because I have that turned on. So now I have the trade. Here's where I have my stop order to the downside and my limit order to the upside. So I am basically able to walk away from my trade now, everybody, and feel comfortable, at least to the extent that I'm allowing the trade to go the direction it's going to go. best case, worst case scenario are relatively set up, except for the fact that we can't define our downside risk. Remember, the only way that you could define the downside with definitive levels is to incorporate an option contract here, right? And we're not going to have time to do that today. So that's the example trade for our example portfolio. Let's see how that one works out for us when we reconvene next Thursday. So with that, everybody, I'm going to wrap it up. Thank you so much for being here. We did cover a few good details for you, some stocks in the news, good look at the broad market, of course, and a green open today that remains green. We'll see if that holds for the remainder of the week. It could be visually a fantastic week on the broad indices if that holds. So thanks to Barb here in the chat. Thanks to all of you for being here and joining me. Always love hearing from you. Follow us on X. Hit that thumbs up button down below for me if you like today's conversation, everybody. But I'm very pleased to be here with you and have you joining us. Look forward to seeing you all again real soon.